Good morning. Good morning. Today is December 10th, and we here at Harvested Financial are looking at the markets. So what do we have to talk about today? Well, first, I want to give a set of brief disclosures that all of the information, commentary, and opinions expressed on this or other websites or on any other social media platform in any media format reflects the personal opinions, viewpoints, and interpretations of the employees providing such comments and are not to be considered a description or offer of advisory services by Harvested Financial. The opinions expressed are for general informational purposes only and not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education about the financial industry, and in no way is the content on this website meant to convey investment advice, performance data, or any specific recommendation to buy or sell securities. Harvested Financial employs multiple methods of analysis and security selection to create client portfolios, which are not discussed in their entirety here. All investments carry the risk of loss, and users should discuss any decisions with their financial advisor. Past performance is not an indication of future results. So now that that is out of the way, let's talk about what is going on in the markets today. Well, a little bit down. The major indices are all off. I'm looking at the SPY. ETFs trading down about $2. That's 57 basis points. The Qs are down 250 themselves, 83 basis points. And IWM is down $1.56 or 83 basis points also. So funny to see the IWM and Qs move in such tandem and exactly the same number down right there. So what are we thinking about today? What are we looking at in the markets? Well, obviously there's some macro factors going on. We're seeing a little bit of pull off. We're coming in from some of these all-time highs that we hit earlier this week. Overall volatility is ticked up a little bit, but there are some single names that are seeing some really interesting action. And one of those single names that we are particularly keen on looking at today is Facebook. So if you were paying attention to the news yesterday, Facebook obviously got some heat. They were looking at two major lawsuits, particularly related to their acquisitions of WhatsApp and Instagram. They've been accused of leveraging sort of M&A action to take out partners. So this has sort of long been a criticism of Facebook that they're using their sort of market power. Excuse me, that powerful. So taking advantage of sort of their market power to scoop up competitors before they could potentially be a threat to them. Remember many years ago, they bought Instagram for what seemed like a crazy sum at the time of $1 billion, but that property has delivered massive value to Facebook. So Facebook's coming under some heat. Stock was down a little bit yesterday. It continues to tick down a little bit today. But I think there are some interesting ways we can talk about the volatility here. So again, I will share my screen and I will pull up my TradeHawk. And let's talk about Facebook. So Facebook's trading around 272 right now. It's down about $5, or almost 2%, just under 2%. So what are we thinking about here? Well, first I actually want to pull up the historical vol chart and show a little bit where both the price action and the volatility action has been here. So if I want to look at the price action, well, remember that is this yellow line right here. So we're looking at this yellow line, stock's up, I believe, 38% on the year, something like that. And that's where that's gone. Even more dramatic from some of those Corona lows, but we've really seen growth in this name over the years. So obviously stock's been on a tear, but what about volatility? And, this red line, of course, is the historical vol, up and down, but implied vol, a little bit more recently, that white line, that 30-day implied vol that I just pulled out here. Let's zero in on where that's been going recently. Once again, we talk about this November sort of peak up here. And actually in Facebook, it came a little bit earlier, closer to the end of October, but it is just drizzled down all the way down here. So, right now we have that reading of yesterday at a 36 implied vol. I believe we're seeing a little bit lower in the markets right now. So actually, come down quite a bit, 36 vol all the way in from 55 at the end of October. So vol has leaked in as stock has, moved up a little bit, but, relatively sideways here overall. But this news today could have some potential impacts on volatility. How are we going to think about trying to play that? Is this a time to get long vol in Facebook? Well, I want to demonstrate just how expensive volatility is and what kind of movements we might be looking for in a name like Facebook if we are to get long vol. So let me clear this out first, but, let's go out, 30 days was the implied vol figure that we were looking at in that chart. So I'm going to look for an option that's about that distance out in the future. So the Jan 15, that serial expo, we talk about the liquidity in serial expos, super important to trade deep liquid markets. So looking at this Jan 15 expo, 36 days out, we are actually seeing that implied vol reading right around that 36 level. So ticking up just a hair again this morning, as typically happens when the stock goes down. So, let's start off with a straddle. Buy a put, buy a call, right around theoretical value of 25 bucks on that trade. So January straddle is pricing $25, a little under 10% move there. So $270 stock, $25 move. That's a big move. Break evens are going to be from 275, call it, break even at 250, break even at 300. So if you buy that straddle, you need to see a move outside of that $50 range that we're talking about. So expensive to buy these straddles out here. Just to put in context what a 36 vol might look like, I'm going to pull out my trusty calculator and do a little back of the envelope work. So the way we calculate the implied daily move is take 252, which is the number of trading days in the year, take square root of that, which is about 16, and divide the volatility, that 36 vol, by 16. So I go 36 divided by 16, 2.25%. So 2.25% on a $273 stock. Whoops, 273 times about a $6.50 move every day. So if we're looking at a $6.50 move every day, we're actually under that today. So maybe this vol isn't so expensive, but if you believe in this lawsuit, causing more turbulence, we are going to look from the long vol perspective. One way to potentially manage the cost of volatility is to use a condor-like structure or to use a butterfly type structure. And we use the condor type structure, we're going to buy the put, spread, maybe look for that a $20 move here. So go from 275 down to 255, and then we're going to buy the similar call spread, buy the 275 call, sell the 295 call. So now we have a debit entry. So this is an iron condor. Remember, with iron condors, debits get us long volatility. With butterflies, credits get us long volatility. So I'll show that in just a minute. But we're going to pay about 15 bucks for this. So that's in from the 25 bucks that we were talking about before. But 15 bucks for this is going to be our debit on the trade. And I'll pull up the what if to show exactly where our break evens are going to look at here. So break evens on this trade. If stock just sits here in a long volatility trade, it is going to decay. Long options, you want them to move away from. So if you're long that 275 line, you're long the call and you're long the put in both of those spreads, you want stock to move away from that level. So long the 275 line, we need to see a $14.88 move. Let's round it up to $15 move in either direction. So we need to see that go above the 290 level here. So that's where that break even is. And then we need to see it go below that 260 level, which is where that break even is right there. So our max loss is actually going to be quite a bit bigger than our max gain because we are expecting a lot. The market's expecting a decent amount of movement beyond those levels. So if it sits right here, we lose all the money that we paid. Worst possible scenario is stock just decays right here at 275. Beyond the 260 level to the downside and beyond that 295 level on the upside, we're going to see potential max profit of just under $600. So one way to easily figure that out is to say the distance between the 295 and the 275, short strike, long strike, minus the debit paid on the trade. So 20 bucks minus the 15 bucks, 14.88, that gives us that little over $500 profit if it moves beyond those levels. So, one way to potentially think about getting, a long vol in a different way would be, instead of doing this for a debit, if you want to establish long vol at a credit where you take in money originally on the trade, we're going to go long a butterfly. So do this all with with the same type of contracts. You can do it all with puts or you can do it all with calls. So I'm going to buy two of the 275 puts. I'm going to sell the 295 put, and I'm going to sell the 255 put. So same exact strikes, but a slightly different debit versus credit structure here. So as I pull up the graph, you will unsurprisingly see a very similar action going on. And ironically, the lines that I have point to exactly the same positions. So the difference here is that you enter into the trade for a credit. So, we're seeing that same max loss of 1,400. This time it's that same arithmetic, just sort of different order in the sense of that 295 minus 275 compared to the credit that you're going to receive on that trade. So your worst case scenario is that it again sits right here at your long strike and you lose that $1,400. Where you achieve all of your credit. So the interesting thing here is that you collect the money at the outset of the trade, and where you maintain all of that is if stock closes outside that 295, 265, or I'm sorry, 260 level. So a different way to play this, it allows you to collect cash at the outset of the trade. You will have to put up margin equal to that $1,500 loss. Whether you're in a reg team margin account, you'll need to put all of that up, or whether you're in a portfolio margin account, there's additional arithmetic that's done there, but you will have to have the margin for this trade, despite the fact that you're collecting it at the outset, and you earn that credit if it realizes outside of those bounds. So two interesting ways from the debit side and the credit side to play the long volatility structure. In some ways, it really depends on risk management structure. Would you prefer to outlay capital now with the potential benefit later, or do you want to collect money now and take advantage of sort of the cash inflow now with the potential loss realization if we do sit there? So Facebook, a lot of potential action going on in the next coming months as we look at some of these DOJ investigations. But this name has always continued to move. So looking at where the implied volatility has been relative to its history might give us some opportunities to think about playing this vol from the long side as this action continues. At Harvested Financial, these are the kind of structures that we manage every day. We look at our benchmarks of IWM, SPY, and QQQ to manage our model portfolios with structures like this that capture volatility and have different bents to the market. Or we also engage with single names. So check us out at our website, harvestedfinancial.com, and check us out on Twitter, harvested_DAFE, because derivatives are for everyone. And if you go in and use promo code Phillips5, that's me, Mark Phillips, Phillips5, you will get your first 3 months for only $5. So that is 50% off our minimum fee, our minimum monthly fee. So check us out, harvestedfinancial/Phillips5, and you will get your first 3 months for only $5. Tune in here every morning. We'll be doing the Daily Bread at 8:35 Central, 9:35 Eastern, talking trade ideas. I appreciate you tuning in, and stick around for more.